Tonight, we're going to talk about something that's going to completely reshape how you think about power, about monies, about everything you thought you knew, about who actually controls the global economy. We're going to explore the largest, most powerful, most influential financial market on Earth, a market so vast that it makes the stock market look like a sideshow, so important that it determines interest rates on everything from your mortgage to government budgets, so complex that most people never realize it exists. And I have to warn you right now, by the end of this, you're going to understand why a bond trader once said, "I used to think if there was reincarnation, I wanted to come back as the president or the pope, but now I want to come back as the bond market. You can intimidate everybody." If you enjoy these deep explorations into the financial systems that actually run the world, consider subscribing or hitting the like button. It really helps the channel grow and allows me to keep making content like this. Let's begin with something familiar: your mortgage. Maybe you bought a house 3 years ago for $450,000. You put down 20% $90,000 you'd been saving for years and took out a mortgage for $360,000. The bank offered you a 30-year fixed-rate mortgage at 3.5% interest. You thought about it for about 15 minutes, signed the paperwork, and forgot about it. Your monthly payment is $1,616. You pay it automatically every month and don't think much about it. This is a scale that makes perfect sense to your brain because it's your home, your biggest purchase, your shelter, your investment. That 3.5% interest rate seemed reasonable, neither amazing nor terrible. Just the going rate, just what mortgages cost in 2021. But here's what you probably didn't know when you signed those papers. Your mortgage, that specific $360,000 loan at 3.5%, doesn't just exist in isolation. Within days or even hours of closing, the bank that gave you the mortgage sold it, not to another bank, to a massive financial institution that bundled your mortgage with thousands of others into a single security called a mortgage-backed bond. That bond was then sold to investors' pension funds, insurance companies, foreign central banks, hedge funds who now own your mortgage payments. Every month when you send that $1,616, it doesn't go to the bank where you got the loan. It goes to bondholders who might be in Tokyo, Frankfurt, or Abu Dhabi. Your mortgage became a bond, and that bond's value fluctuates every single day based on prevailing interest rates, economic conditions, inflation expectations, Federal Reserve policy, and global capital flows. This is your first glimpse into the bond market, the place where your personal financial decisions connect to global financial forces worth hundreds of trillions of dollars. Now, you might be thinking, so what? My payment is still $1,616 per month. Why does it matter who owns my mortgage? It matters because the interest rate you got, that 3.5%, was determined by the bond market. Not by your bank, not by the Federal Reserve directly, by the bond market. When you applied for your mortgage in 2021, the bank didn't just pick 3.5% out of thin air. They looked at the yield on 10-year Treasury bonds, the benchmark interest rate in the global economy, which was around 1.5% at the time. They added a spread of about 2% to cover their costs, the risk of lending to you, and profit margin. 1.5% plus 2% equals 3.5%. If Treasury yields had been 4%, your mortgage rate would have been 6%. If Treasury yields had been 0%, your rate might have been 2%. The bond market, specifically the $26 trillion U.S. Treasury bond market, set the baseline rate that determined your mortgage payment for the next 30 years. Let's make this concrete. At 3.5%, your $360,000 mortgage costs you $1,616 per month. Over 30 years, you'll pay $581,760, total $221,760 in interest alone. If the bond market had priced treasuries higher, forcing your rate to 6%, your monthly payment would be $2,158. Over 30 years, that's $776,880, total $416,880 in interest. The difference, $195,120 more in total payments. Nearly $200,000 more over the life of your loan, determined entirely by where the bond market priced treasury yields when you got your mortgage. You didn't negotiate with the bond market. You didn't even know it was involved, but it determined the single biggest financial decision of your life. This is the invisible power of the bond market. Most people have never heard of it. Most people couldn't explain what a bond is if you asked them, but it controls the cost of borrowing for everyone, individuals, corporations, governments. Let me explain what a bond actually is, because understanding this simple financial instrument is the key to understanding how the modern economy actually works. A bond is a loan. That's it, just a loan, but formalized and tradable. When you take out a mortgage, you're borrowing money from a bank and promising to pay it back with interest. When a government issues a bond, they're borrowing money from investors and promising to pay it back with interest. Same concept, different scale. Here's how it works. The U.S. government needs to borrow $1 million to fund operations. They issue a bond, let's say a 10-year treasury bond, with a 3% interest rate, called the coupon rate. An investor buys this bond for $1 million. Every year for 10 years, the government pays the investor $30,000 in interest, 3% of $1 million. At the end of 10 years, the government gives back the original $1 million. Simple, right? The government gets money now. The investor gets steady interest payments, plus their money back eventually. But here's where it gets interesting. That bond can be sold. The investor who bought it for $1 million doesn't have to hold it for 10 years. They can sell it tomorrow to someone else. And the price it sells for might not be $1 million. If interest rates in the broader economy rise to 5%, suddenly a bond paying only 3% looks unattractive. No one wants to pay $1 million for an investment yielding 3% when they could get 5% elsewhere. So the bond's price falls maybe to $850,000. At that lower price, the bond becomes attractive again. Why? Because the buyer still gets $30,000 per year in interest payments, but they only paid $850,000 for it. Their effective yield is now about 3.5%, $30,000 $850,000. Plus they'll get $1 million back at maturity, a capital gain of $150,000. This inverse relationship between bond prices and interest rates is fundamental. When rates rise, bond prices fall. When rates fall, bond prices rise. This might seem abstract, but it affects you directly. Remember your 3.5% mortgage from 2021. In 2022, the Federal Reserve started raising interest rates aggressively to fight inflation. Treasury yields went from 1.5% to over 4.5%. Mortgage rates went from 3.5% to 7.5%. If you bought your house in 2023 instead of 2021, that same $360,000 loan at 7.5% would cost you $2,517 per month, $900, one more than your payment. Over 30 years, that's an extra $324,360 in total cost. The bond market's movement from 2021 to 2022 made buying a house $324,360 more expensive over the life of a loan. Not because houses got better, not because construction costs doubled, because interest rates set by the bond market changed. This is power. The power to make housing affordable or unaffordable. The power to enable or destroy the American dream of homeownership. The power to determine who can afford a house and who cannot. And this is just mortgages. The bond market determines interest rates on car loans, credit cards, student loans, business loans, corporate bonds, municipal bonds, and government debt worldwide. Your credit card charging 22% interest. That rate is Treasury yield, currently tilde 4.5% plus, a spread for your credit risk, tilde 17.5%. If Treasury yields were 1%, your card might charge 14%. If Treasury yields hit 7%, your card could charge 24% plus. Student loans, car payments, business credit lines, all priced off the bond market's baseline interest rate. Now let's talk about scale. Your $360,000 mortgage is real money to you. Life-changing money. Probably the largest debt you'll ever carry. But in the bond market, $360,000 is invisible. It's a rounding error within a rounding error. Let me show you why. The total size of the global bond market is approximately $130 trillion. Let me put that in perspective. If you saved your entire $360,000 mortgage amount every single year, never spending a penny, it would take you 361 million years to accumulate $130 trillion. Humanity has existed for maybe 300,000 years. You'd need to save for over 1,000 times longer than humans have walked the earth. Your mortgage is 0.0000002% of the global bond market. Completely, utterly, microscopically insignificant to the market as a whole. But here's the thing. Compared to specific segments of the bond market, even $130 trillion is just one piece. And compared to the derivatives based on bonds, that $130 trillion is dwarfed. And compared to the actual power the bond market wields over governments, corporations, and central banks, the dollar amounts are almost beside the point. We're about to climb a ladder of scale, each rung making the previous one look microscopic. From your mortgage to mortgage-backed securities, from MBS to treasury bonds, from treasuries to corporate debt, from corporate debt to global sovereign bonds, from sovereign bonds to the derivatives markets, and finally to the actual political and economic power these markets wield over nations. Along the way, you'll discover why the bond market is called the smart money, why bond traders are often more influential than elected officials, why countries fear bond market reactions more than public opinion, and why understanding bonds is essential to understanding how power actually works in the modern world. Let's start with something closer to home and build up. Your city probably has bonds outstanding. Municipal bonds, or munis, are how cities, counties, and states borrow money for infrastructure. Let's say your city wants to build a new high school $100 million project. They don't have $100 million in cash, so they issue municipal bonds. Investors buy these bonds, giving the city $100 million now. The city pays interest to bondholders for 20 years, then repays the principal. Your property taxes fund these interest payments. Every month, part of your tax bill goes to paying bondholders who funded the school, the road repairs, the water system upgrades. Nationally, there's about $4 trillion in outstanding municipal bonds. Every city, county, and state combined owes $4 trillion to bondholders. That's about $12,000 for every American, paid through state and local taxes over time. But muni bonds are just the beginning. Corporate bonds are much larger, about $10 trillion in the US, $14 trillion globally. Every major corporation finances itself partly through bonds. Apple has about $100 billion in bonds outstanding. AT&T has $150 billion. Toyota, Volkswagen, Shell, Saudi Aramco all have tens of billions in bonds. When a corporation wants to build a new factory, they don't use all their own cash. They issue bonds. Investors give them money now. The corporation pays interest for 10-30 years, then repays the principal. This corporate debt funds most major business investments, factories, equipment, research, acquisitions. The modern corporate economy runs on borrowed money, and bonds are how that borrowing happens. But even $14 trillion in corporate bonds is small compared to the big one. Government bonds. The U.S. government alone has $34 trillion in debt outstanding. All of it in the form of treasury bonds, notes, and bills. Every dollar of that debt was created by the government selling bonds to investors. Other countries have huge debt too. Japan, $9 trillion. China, $7 trillion. Germany, France, UK, Italy each with $2-3 trillion. Total global government debt is about $75 trillion. Add it all up: municipal bonds, corporate bonds, government bonds, mortgage-backed securities, asset-backed securities, and you get that $130 trillion global bond market. But these aren't just numbers on a screen. This is how the entire modern economy is financed. Everything around you, the roads you drive on, the buildings you work in, the products you buy, the services you use, most of it was built with borrowed money. And that borrowed money came from the bond market. Your mortgage is your personal participation in this system. You borrowed money to buy a house. That money came from the bond market. You're paying it back to bondholders through your monthly payment. And the interest rate you pay was set by the bond market's assessment of current economic conditions, inflation expectations, central bank policy, and the supply and demand for credit. No, most people with mortgages don't think about any of this. They know their payment amount. They know their interest rate. They pay it every month and move on with their lives. But the system is always working, always processing information, always adjusting interest rates based on economic data, inflation trends, central bank signals, and global capital flows. And those interest rate adjustments affect everything. When you hear on the news that the Federal Reserve raised interest rates by 0.25%, what actually happened is the Fed adjusted their target for overnight lending rates between banks. But the bond market responds by repricing trillions of dollars of bonds, which changes yields, which changes all the interest rates in the economy: your mortgage rate, your car loan rate, corporate borrowing rates, government borrowing costs. 1/4 point move by the Fed ripples through $130 trillion in bonds and affects everyone's cost of borrowing. Let me make this visceral with some real numbers. In 2020, average mortgage rates hit 2.65%, the lowest in history. A $400,000 mortgage at that rate costs $1,609 per month. Total cost over 30 years, $579,280. By late 2023, average mortgage rates hit 7.8%, the highest in 23 years. That same $400,000 mortgage now costs $2,866 per month. Total cost over 30 years, $1,031,760. The difference, $452,480 more in total payments. Same house, same loan amount, but the bond market's movement from 2020 to 2023 made that loan cost nearly $500,000 more over its lifetime. This is the power we're talking about. Not abstract, not theoretical, Real money affecting real people's ability to buy homes, start businesses, go to college, buy cars. And it all comes back to the bond market and the interest rates it sets. But here's what makes the bond market truly fascinating. It's not controlled by any single entity. Not the government, not the Federal Reserve, not any bank or institution. The bond market is the collective judgment of millions of investors' pension funds, insurance companies, hedge funds, foreign central banks, sovereign wealth funds, individual investors all buying and selling bonds based on their assessment of economic conditions and the appropriate interest rate. When these investors collectively decide that 3% isn't enough compensation for lending money for 10 years, they sell bonds. Bond prices fall, yields rise, interest rates across the economy increase. When investors decide they're happy with 3% or that they expect rates to fall further, they buy bonds. Prices rise, yields fall, interest rates decrease. No one controls this. The Federal Reserve influences it by setting short-term rates. The government influences it by how much they borrow. But ultimately, the bond market is a massive decentralized system of price discovery, constantly finding the interest rate that balances supply of bonds with demand for them. This makes the bond market the closest thing we have to a pure market assessment of economic health, inflation risk, and appropriate compensation for risk. And that assessment is brutal, honest, and usually right. When a government borrows too much, the bond market demands higher interest rates to compensate for the risk. When inflation rises, bondholders demand higher yields to maintain real returns. When a recession approaches, the bond market signals it by inverting short-term rates exceeding long-term rates, a pattern that has predicted almost every recession. The bond market sees what's coming before economists, before policymakers, before almost anyone else. And it adjusts trillions of dollars of pricing accordingly, sending signals that affect everyone's cost of borrowing. Your $1,616 mortgage payment exists within this vast system. Protected when the bond market is calm and rates are low. Vulnerable when the bond market panics and rates spike. Growing or shrinking in real terms as inflation rises or falls. But to truly understand what the bond market reveals about economic power and how it shapes the modern world, we need to go much deeper. Beyond your personal mortgage, beyond simple concepts of loans and interest, into the structure of the bond market itself, the different types of bonds, who owns them, how they trade, what their prices signal, and why bond traders wield more power than almost any other group in finance. Because your mortgage is just the beginning. The entry point to understanding a market so large, so important, so powerful that it determines the fate of governments, the viability of businesses, and the prosperity of nations. We're about to climb the ladder. From individual mortgages to mortgage-backed securities, from MBS to the Treasury market, from treasuries to corporate credit, from corporate credit to sovereign debt crises, from crises to the derivatives that dwarf everything, and finally to the actual mechanics of how the bond market intimidates presidents, prime ministers, and central bankers. Each step will make the previous one look microscopic. Each level will reveal new dimensions of how the bond market functions as the true power center of the global financial system. And by the end, you'll never look at your mortgage payment the same way again. You'll understand that those $1,616 leaving your account every month aren't just going to some bank. They're flowing into the largest, most sophisticated, most powerful market on earth, a market that sets the price of money itself, that disciplines governments more effectively than voters, that signals economic turning points before anyone else sees them. The bond market, where the real power lies. Let's talk about the most important market you've never heard of, The U.S. Treasury market. Every financial transaction in the world, every mortgage, every car loan, every corporate bond, every government debt issue is priced relative to U.S. Treasury bonds. They are the benchmark, the risk-free rate, the foundation on which all other interest rates are built. Why treasuries? Because the U.S. government has never defaulted on its debt. For over 230 years, through wars, depressions, financial crises, political chaos, and every imaginable stress, the U.S. has always paid bondholders exactly what it promised. This perfect payment record creates something remarkable, a truly risk-free asset. When you lend money to the U.S. government by buying a treasury bond, you will get your money back. Period. The only risks are inflation and opportunity cost, not default. This makes treasury yields the purest expression of the time value of money. What should investors earn for lending money risk-free for 2 years, 10 years, 30 years? The treasury market answers this question every second of every trading day. The treasury market is massive $26 trillion in outstanding debt. For context, that's larger than the entire GDP of China. It's larger than the stock market capitalization of every country except the United States. It's the single largest securities market on Earth. And it trades constantly. Daily trading volume in treasuries is $600-700 billion. Every single day, $600 to $700 billion of U.S. government bonds change hands. To put that in perspective, the entire U.S. stock market trades about $500 billion per day. The treasury market trades more than the stock market every day, despite being far less visible to ordinary people. Why such enormous volume? Because treasuries aren't just investments. They are the grease that lubricates the entire global financial system. Banks use treasuries as collateral for short-term borrowing in the repo market. Hedge funds use treasuries to implement trading strategies. Foreign central banks hold treasuries as reserves backing their currencies. Pension funds hold treasuries as safe assets, matching long-term liabilities. Insurance companies hold treasuries to meet regulatory requirements. The treasury market is infrastructure. Not optional, not speculative, essential to the functioning of global finance. Now, let's talk about the different types of treasury securities, because each tells us something different about the economy. Treasury bills, T-bills, mature in 1 year or less, typically 4 weeks, 8 weeks, 13 weeks, 26 weeks, or 52 weeks. These are short-term government IOUs. The government borrows money for a few months, pays no interest, but sells the bill at a discount to face value. For example, a 26-week T-bill with $10,000 face value might sell for $9,800. You pay $9,800 today, get $10,000 in 6 months. Your $200 profit is the interest. T-bill yields represent the safest short-term parking place for cash in the world, currently yielding around 5.3%. They're where money market funds, corporations, and individuals park cash they might need soon. Treasury notes mature in 2 to 10 years, specifically 2-year, 3-year, 5-year, 7-year, and 10-year maturities. These pay interest semi-annually and return principal at maturity. The 10-year Treasury note is the most important security in the world. Why? Because the 10-year yield is the benchmark for most long-term interest rates. Mortgage rates track the 10-year. Corporate bond yields are priced as spreads over the 10-year. Stock valuations are often justified relative to the 10-year yield. When financial media says Treasury yields rose today, they almost always mean the 10-year yield. When investors talk about the risk-free rate, they usually mean the 10-year. It's the single most watched price in global finance. Currently, the 10-year yield is around 4.4%. That means investors lending money to the U.S. government for a decade demand 4.4% annual interest. This sets the baseline for everything else. Your mortgage rate. 10-year yield 4.4% plus spread 2-3% equals 6.4-7.4% mortgage rate. Corporate bonds. 10-year yield 4.4% plus credit spread 1-5% depending on company quality equals 5.4-9.4% corporate bond yields. Everything prices off the 10-year. Treasury bonds mature in 20 or 30 years. These are ultra-long-term government debt. The 30-year Treasury bond, sometimes called the long bond, represents the government's cost of borrowing for a generation. Pension funds love these because they have long-term liabilities pensions. They'll pay in 30 years and 30-year bonds, help them match assets to those liabilities. Currently yielding around 4.6%. The 30-year tells us what investors expect for inflation and interest rates over the next 3 decades. Now here's where it gets fascinating. The yield curve. The yield curve is a graph showing Treasury yields at different maturities, from 1-month bills to 30-year bonds. Normally, longer maturities pay higher yields because there's more uncertainty over longer periods. You demand more compensation for lending money for 10 years than for 3 months. A normal yield curve slopes upward. 3-month bills might yield 5.0%, 2-year notes 4.5%, 10-year notes 4.4%, 30-year bonds 4.6%. Wait, that doesn't slope upward. You're right. That's actually an inverted yield curve, short-term rates exceeding long-term rates. And an inverted yield curve is one of the most reliable recession predictors in existence. Here's why inversion matters. When short-term rates exceed long-term rates, it signals that investors expect the Federal Reserve to cut rates in the future, which typically only happens during recessions. The logic: if you think the Fed will cut rates from 5% to 3% over the next 2 years due to recession, you'd rather lock in a 10-year bond at 4.4% now than roll over short-term bills that will soon yield only 3%. This demand for long-term bonds pushes their prices up and yields down, while lack of demand for short-term bills pushes their prices down and yields up, creating inversion. The yield curve inverted in 2006, predicting the 2008 recession. It inverted in 2000, predicting the 2001 recession. It inverted in 1989, predicting the 1990 recession. It inverted in 1980, predicting the 1981-82 recession. Every U.S. recession in the past 50 years was preceded by yield curve inversion, typically 12-18 months in advance. The bond market saw them coming before economists, before policymakers, before anyone else. The yield curve inverted in July 2022 and remained inverted through 2023. The bond market was screaming, "Recession is coming." As of late 2023, that recession hadn't arrived yet, making this either a false signal or a delayed one. This is the power of the Treasury market as an information processor. Millions of investors, collectively assessing economic conditions and pricing bonds accordingly, create a yield curve that predicts the future more accurately than any economist or model. Now let's talk about who owns these $26 trillion in treasuries, because ownership reveals global power dynamics. Foreign governments and central banks own about $7.6 trillion in U.S. Treasuries, roughly 30% of the total. Japan is the largest foreign holder with $1.1 trillion. China is second with $820 billion, down from over $1.3 trillion a few years ago. The UK holds $670 billion. mostly on behalf of other investors, using London as a financial hub. Why do foreign countries hold trillions in US debt? Several reasons, all revealing important dynamics. First, reserve management. Countries need foreign currency reserves to stabilize their own currencies, defend against financial attacks, and maintain confidence in their economic management. U.S. Treasuries are the safest, most liquid reserve asset available. They can be sold instantly for dollars, which are needed for international trade. Second, trade surplus recycling. When China exports more to the U.S. than it imports, it accumulates dollars. What to do with those dollars? Buy U.S. Treasuries. It's the safest way to store value while earning interest. Third, currency management. Some countries, especially in Asia, deliberately keep their currencies weak relative to the dollar to support export industries. They do this by selling their currency and buying dollars/treasuries, which keeps demand for their currency low and demand for dollars high. This creates a fascinating dynamic. The U.S. borrows from the rest of the world to fund its deficits, but this borrowing also props up the dollar and makes it easier for the U.S. to keep borrowing. It's sometimes called Bretton Woods Roman II, a system where the U.S. provides reserve currency and military security, while export-oriented countries provide manufactured goods and financing for U.S. deficit. But this relationship creates tension. Foreign holders of treasuries have enormous theoretical power. If China dumped its $820 billion in treasuries, it could spike U.S. interest rates, crashing the bond market and causing a financial crisis. Except, China can't actually do this. Selling $820 billion of treasuries would tank their value before China could exit. China would suffer massive losses. The dollar would initially weaken, hurting China's exports. And China would still need to do something with the dollars it received from selling treasuries, and there's no alternative asset as large and liquid as treasuries. This is called the nuclear option that neither side can actually use. The U.S. and China are locked in mutually assured financial destruction. China needs the U.S. to buy its exports. The U.S. needs China to finance its deficits. Neither can easily escape. Russia tried in 2018, selling off most of its $150 billion in treasuries to reduce exposure to U.S. financial power. It barely caused a ripple. Other buyers immediately absorbed the sales. The treasury market is so large and liquid that even $150 billion is digestible. This reveals a deep truth about the treasury market. It's the foundation of American power. Not military power, though that matters. Financial power. The ability to borrow unlimited amounts in your own currency at low rates, giving you fiscal flexibility that other countries can only dream of. Domestic investors hold the rest, about $18.4 trillion. This breaks down roughly as follows. Federal Reserve, $5.0 trillion, accumulated through quantitative easing. The Fed created money and bought treasuries to lower long-term interest rates. They're now slowly selling these bonds back to the market through quantitative tightening. Mutual funds and ETFs, $3.5 trillion, held by investors seeking safe assets or implementing bond strategies. State and local governments, $1.2 trillion, parking tax revenue and bond proceeds. Pension funds, $2.8 trillion, matching long-term liabilities with safe long-term assets. Insurance companies, $1.5 trillion, meeting regulatory requirements for safe assets. Banks, $1.0 trillion, held as high-quality liquid assets for regulatory purposes and collateral for borrowing. The remaining $3.4 trillion is spread across hedge funds, corporations, individuals, and other entities. This ownership structure matters because different holders have different motivations and time horizons. Foreign central banks are long-term holders. They don't trade much. They accumulate during trade surpluses and hold for decades. The Federal Reserve is a policy-driven holder. They buy when they want to ease monetary policy, sell when they want to tighten. Hedge funds are active traders. They try to profit from interest rate movements, yield curve changes, and relative value between different bonds. Pension funds are buy and hold investors. They need safe long-term returns and rarely sell. This mix creates interesting dynamics. When the Fed is buying heavily QE, they are absorbing supply and pushing yields down. When they're selling QT, yields rise. When foreign central banks reduce purchases, as happened in 2022, yields spike because a major buyer stepped back. The Treasury market is constantly balancing supply and demand. The government keeps issuing new debt, currently borrowing about $1.5-2 trillion per year to cover deficits. That's new supply hitting the market continuously. If demand doesn't keep up with supply, yields must rise to attract buyers. If demand exceeds supply, yields fall as buyers compete for limited bonds. This supply-demand balance determines the risk-free rate, which determines all other interest rates, which affects the cost of everything financed with debt, which is basically the entire modern economy. Let me give you a concrete example of how this works. In March 2020, when COVID hit, everyone panicked and tried to sell everything for cash. Even treasuries, supposedly the safest asset, were sold frantically. Treasury prices fell, yields spiked not because anyone thought the U.S. would default, but because of forced selling and margin calls. The 10-year yield, which had been 0.7%, briefly spiked above 1.2% in a matter of days, a huge move in Treasury terms. The Federal Reserve intervened with emergency measures, unlimited Treasury purchases, repo operations, new lending facilities. They bought $1.5 trillion in treasuries in 3 months, absorbing the panicked selling and stabilizing prices. This worked. Yields fell back to 0.6% by August 2020 and stayed low through 2021. The Fed's willingness to be the buyer of last resort prevented a treasury market meltdown that would have cascaded through all financial markets. This episode revealed something crucial. Even the Treasury market, the largest, most liquid market on Earth, can experience dysfunction during extreme stress. And when it does, only the Federal Reserve has the firepower to stabilize it. This creates a strange situation. The Fed is supposed to be independent, setting monetary policy for economic objectives, but they are also the implicit backstop for the Treasury market, forced to intervene during crises to prevent system-wide collapse. This dual role creates conflicts. What if the Fed wants to tighten monetary policy by selling treasuries, but the Treasury market is fragile? They might be forced to keep buying to prevent dysfunction, even though they should be tightening. We saw hints of this in 2022-23. The Fed wanted to shrink its balance sheet QT while also raising rates. But Treasury market liquidity was deteriorating. Some worried the Fed might have to pause QT to support market functioning, even though their policy goal was tightening. This is the Treasury market's power over the Fed itself. Even the central bank must respect market capacity and liquidity. They can't just dictate terms. They must work within market constraints. Now let's talk about Treasury auctions, because this is how new debt actually gets issued. Every week, the U.S. Treasury Department auctions new bills, notes, and bonds to fund government operations. In fiscal year 2023, they issued about $23 trillion in new securities. Wait, $23 trillion. But total debt is only $34 trillion. How can they issue $23 trillion in 1 year? Because most auctions are refinancing. When a 10-year note matures, the Treasury issues a new 10-year note to pay off the old one. This happens continuously. Only the deficit, currently $1.5-2 trillion per year, represents net new borrowing. Auctions work through competitive bidding. The Treasury announces, "We're selling $40 billion in 10-year notes next Tuesday." Investors submit bids. "I'll buy $100 million at 4.35% yield, or $500 million at 4.40%. The Treasury accepts bids starting with the lowest yield, highest price, and works up until they've sold all $40 billion. The highest accepted yield becomes the auction rate. Strong auctions, where demand exceeds supply and yields, come in low, signal investor confidence. Weak auctions, where the Treasury barely finds enough buyers and has to accept high yield, signal concern about U.S. fiscal trajectory or economic conditions. In 2023, some auctions weakened noticeably. The Treasury had to accept higher yields than expected. Bid-to-cover ratios, total bids divided by amount sold, declined. Foreign buyers pulled back. This wasn't catastrophic, but it was a warning sign. The market's infinite appetite for U.S. debt might have limits. If the government keeps borrowing $2 trillion per year indefinitely, at some point investors might demand significantly higher yields to absorb the supply. This brings us to fiscal sustainability and the bond market's role as disciplinarian. The U.S. government can theoretically borrow unlimited amounts because it borrows in its own currency. Unlike Greece or Argentina, it can never be forced to default. It can always print dollars to pay bondholders. But printing dollars to pay debts creates inflation. And inflation destroys the value of bonds. Bondholders understand this. So if the government borrows too recklessly, bondholders demand higher yields to compensate for inflation risk. This is the bond market's disciplining mechanism. Politicians might promise voters unlimited spending with no tax increases, but the bond market says, if you do that, we'll demand 7% or 10% or 15% yields, making your debt service costs explode. This threat rising yields, making deficits unsustainable, forces some degree of fiscal responsibility, even on governments that control their own currencies. The UK learned this in September 2022. New Prime Minister Liz Truss announced massive unfunded tax cuts, £45 billion in reduced revenue, with no spending cuts to offset them. The bond market revolted. UK government bond yields, called gilt yields, spiked from 3.5% to 4.5% in days. The pound crashed to a record low against the dollar. Pension funds faced margin calls on their bond holdings. Within 3 weeks, Truss was forced to reverse the tax cuts. Within 6 weeks, she resigned. The bond market had effectively vetoed her government's fiscal policy and ended her political career. This is what that bond trader meant about wanting to come back as the bond market. The bond market can intimidate everybody, even prime ministers of major economies. The same dynamic applies to the U.S., though less acutely because the dollar is the global reserve currency. If U.S. deficits become extreme, Treasury yields will rise, making debt service costs explode, eventually forcing fiscal adjustment. Currently, the U.S. pays about $900 billion per year in net interest on the debt, roughly $2,700 per American per year, just on interest. As debt grows and yields rise, this could easily hit $1.5-2 trillion per year within a decade. At that point, interest costs exceed defense spending, Medicare, or any other government program except Social Security. The bond market's demand for higher yields would force difficult fiscal choices: raise taxes, cut spending, or keep borrowing at ruinous rates. This is the bond market's ultimate power. It can force policy changes through the price mechanism, without any formal authority or democratic process. Now let's talk about the other side of the bond market: corporate debt. Because while treasuries might be the foundation, corporate bonds are where capitalism actually happens. The global corporate bond market is about $14 trillion. That's every company that's issued bonds to fund operations, growth, acquisition, or refinancing. From Apple's $100 billion to your local hospital's $50 million. It's all part of the corporate bond market. Corporate bonds work exactly like treasuries, with one crucial difference: credit risk. The U.S. government won't default. Apple probably won't default. But plenty of companies do default, so corporate bonds must pay higher yields than treasuries to compensate for that risk. This yield premium is called the credit spread. It's the difference between a corporate bond's yield and a comparable treasury. Example: a 10-year treasury yields 4.4%. Apple's 10-year bond yields 4.9%. The credit spread is 0.5% or 50 basis points. Investors demand an extra 0.5% per year to lend to Apple instead of the U.S. government. Why only 0.5% for Apple? Because Apple is incredibly safe. They have $170 billion in cash and equivalents, minimal debt relative to their cash flow, and strong, stable earnings. The probability of Apple defaulting in 10 years is extremely low, maybe 0.1% or less. Compare that to a struggling retailer like Macy's. Their 10-year bonds might yield 8.5%, a 4.1% spread over treasuries. Much riskier. Retail is challenging. Competition is brutal. Consumer spending is uncertain. Macy's could file bankruptcy within 10 years. Investors demand much higher compensation for that risk. Credit rating agencies Moody's, S&P, Fitch assign ratings to corporate bonds based on default probability. AAA is the highest rating. Virtually no chance of default. Only 2 U.S. companies currently have AAA ratings: Microsoft and Johnson & Johnson. AA and A ratings are investment-grade low default risk, suitable for conservative investors like pension funds and insurance companies. BBB is the lowest investment-grade rating. Still relatively safe, but starting to show some vulnerability. Companies like Ford, Boeing, and AT&T are rated BBB solid businesses, but with enough debt or operational challenges to warrant caution. Below BBB is junk or high-yield territory. These companies have significant default risk. Maybe they are heavily indebted. Maybe their industry is in decline. Maybe their business model is uncertain. Whatever the reason, there's a meaningful chance they won't pay bondholders back. High-yield bonds might yield 7-10% or more, compared to 4.4% for treasuries. That extra 3-6% compensates for the risk that 5-10% of high-yield bonds default in any given year. This creates an entire ecosystem of credit analysis. Thousands of analysts at investment firms, rating agencies, hedge funds, and banks spend their careers evaluating corporate credit risk. They read financial statements, analyze industry trends, assess management quality, evaluate competitive positioning, all to determine what's the right yield for this company's bonds. And the market aggregates all this analysis into a single number: the credit spread. When credit spreads are narrow, say 1-2% on average, it signals investor confidence. The economy feels stable. Companies are healthy. Default risk is low. Investors are comfortable taking credit risk for modest extra yield. When credit spreads widen to 4-5% or more, it signals investors expect defaults to rise, likely because recession is coming. They demand much higher compensation for credit risk. Credit spreads are one of the most reliable recession indicators. They widened dramatically before the 2008 recession, before the 2001 recession, before the 1990 recession. The bond market sees deteriorating credit conditions before the recession officially arrives. In 2008, high-yield spreads went from 3% in early 2007 to over 20% by December 2008. 20% spreads meant junk bonds were yielding 25% plus, while treasuries yielded 2-3%. The bond market was screaming, corporate defaults are about to explode. And they did. Default rates hit 13% in 2009, meaning 13% of junk-rated companies defaulted on their bonds. Bondholders lost billions, but those who paid attention to credit spreads in 2007 got out early and avoided the carnage. Credit spreads also reveal sector-specific stress. Energy company bond spreads spiked in 2015-16 when oil prices collapsed. Bank bond spreads exploded in 2008 during the financial crisis. Retail spreads widened in 2017-19 as e-commerce crushed traditional retailers. These spread movements signal industry distress before it shows up in bankruptcy filings or unemployment statistics. Now let's talk about leverage and why corporate debt matters so much. Leverage is the ratio of debt to equity or debt to cash flow. A company with $1 billion in debt and $10 billion in market cap has 10% leverage relatively safe. A company with $10 billion in debt and $1 billion in market cap has 1,000% leverage extremely risky. When companies take on lots of debt, they amplify returns in good times but face bankruptcy in bad times. Example: a company earning $100 million annually with no debt keeps all the profit for shareholders. But if they borrow $1 billion at 5% interest, they owe $50 million per year in interest. That leaves only $50 million for shareholders, cutting profit in half. Why would they do this? Because they can use that $1 billion to buy back stock, reducing shares outstanding. If there were 100 million shares, buybacks might reduce it to 80 million. Now those 80 million shares get $50 million in profit, $0.63 per share, instead of $1.00 per share for 100 million shares. Wait, that's worse. But stock buybacks also boost stock prices by reducing supply. And interest payments are tax deductible while dividends aren't. And leverage can boost return on equity even if earnings per share falls. The math gets complex, but the basic idea is that moderate debt can create value for shareholders. The problem is when debt gets excessive. If earnings drop to $50 million, but interest costs are still $50 million, there's nothing left for shareholders. If earnings drop further, the company can't pay its bondholders and faces bankruptcy. This is why credit spreads widen during economic downturns. Investors realize that leveraged companies will struggle to service their debt if revenue or profit falls. In 2007, private equity firms bought companies using massive leverage, leveraged buyouts, LBOS. They'd buy a company for $5 billion, using $1 billion of equity and $4 billion of debt. If the company's value rose to $7 billion, the equity was worth $3 billion, tripling the initial $1 billion, while debt stayed at $4 billion. This works brilliantly in good times. But in 2008, many LBO companies couldn't service their debt as earnings collapsed. Bondholders lost money. Some companies went bankrupt. The leverage that amplified gains on the way up amplified losses on the way down. Corporate debt loads have grown significantly over the past 15 years. Low interest rates after 2008 encouraged companies to borrow heavily. Total non-financial corporate debt in the US is now about $11 trillion, up from $6 trillion in 2008. Much of this borrowing funded stock buybacks and dividends rather than productive investment. Companies borrowed at 3% to buy back stock, boosting earnings per share and enriching executives whose compensation was tied to stock price. This worked beautifully from 2009-2021 as rates stayed low and stock prices soared. But now rates are 5% plus, making debt service expensive. Companies that borrowed heavily are facing higher refinancing costs as old bonds mature and must be replaced with new bonds at higher rates. This is called a maturity wall, a wave of corporate bonds maturing in coming years that must be refinanced at much higher rates. About $1.5 trillion in corporate bonds mature in 2024-2025. If rates stay elevated, companies will face sharply higher interest costs, eating into profits and potentially forcing defaults. The bond market is already pricing this risk through widening credit spreads in vulnerable sectors. Now let's talk about a particularly important segment: commercial real estate. Commercial real estate office buildings, shopping malls, hotels is heavily financed with debt. A developer building a $500 million office tower might put down $100 million equity and borrow $400 million through a combination of bank loans and commercial mortgage-backed securities (CMBS). This worked fine when interest rates were 3% and buildings were fully leased. But post-COVID, office vacancy rates hit record highs as remote work reduced demand. Some cities have 20-30% office vacancy. Meanwhile, interest rates quintupled from 1% to 5% plus. Buildings that were profitable at 3% interest rates became unprofitable at 7% rates. Many can't generate enough rental income to cover debt service. This created a commercial real estate crisis visible in the bond market. CMBS spreads widened significantly in 2023. Prices on commercial real estate bonds fell 20-30% or more for distressed properties. The bond market was pricing in massive losses. And losses are coming. Banks holding commercial real estate loans are facing write-downs. Some regional banks failed in 2023 partly due to commercial real estate exposure, combined with bond losses from rising rates. The bond market saw this developing in 2022 through widening CMBS spreads and falling prices. Before headlines about office vacancies or bank failures, the bond market was signaling trouble in commercial real estate. This is the bond market's power as an early warning system. It processes information about credit risk, economic conditions, and sector health, then embeds that information in spreads and prices that move before the problems become obvious. We need to talk about what happens when the bond market really breaks. Because sovereign debt crises reveal the ultimate limits of borrowing and the bond market's disciplinary power. Greece is the canonical example. In 2009, Greece revealed it had been hiding the true size of its deficits. Rather than the reported 6% of GDP, the real deficit was 13%. Total debt was 130% of GDP and rising fast. The bond market's response was swift and brutal. Greek government bond yields spiked from 4% to 7% to 12% to eventually over 40% in 2012. 40% yields. The bond market was saying, there is a very high probability Greece will default. We demand enormous compensation to lend them money. At 40% yields, Greece couldn't borrow. No one would buy their bonds at reasonable rates. They faced imminent default. The entire European banking system was at risk because European banks held hundreds of billions in Greek bonds. This forced a bailout. The European Union and IMF provided emergency loans totaling euros 240 billion to prevent Greek default. In exchange, Greece had to implement brutal austerity, massive spending cuts, tax increases, pension reductions, public sector layoffs. The result was economic depression. Greek GDP fell 25% from peak to trough. Unemployment hit 28%, youth unemployment over 60%. An entire generation was economically scarred. But the bond market got what it wanted. Greece couldn't borrow excessively anymore. Their deficits were forced down to sustainable levels. Debt service was restructured. The bond market's punishment was severe and effective. This same dynamic played out in Ireland, Portugal, Spain, and Italy during the European debt crisis of 2010-2012. Bond yields spiked. Governments faced market lockout. Austerity was imposed. Economies suffered, but fiscal discipline was eventually restored. The bond market doesn't care about human suffering. It cares about getting paid back. When default risk rises, yields spike until governments implement policies that restore sustainability regardless of the economic or social cost. Argentina provides an even more dramatic example. Argentina has defaulted on its sovereign debt 9 times since independence in 1816. Most recently in 2001, $82 billion default, and 2020, $65 billion restructuring. After each default, Argentina is locked out of bond markets for years. When they eventually regain access, they must pay enormous yields, often 10-15%, because their track record is terrible. This creates a vicious cycle. High yields make debt service expensive. Expensive debt service makes deficits worse. Worse deficits require more borrowing at high yields. Eventually, it becomes unsustainable and they default again. The bond market disciplines Argentina harshly for serial defaults. But Argentina keeps defaulting because fixing their fiscal problems requires political changes they haven't managed to implement. This reveals a truth about sovereign debt. Bond markets can force austerity, but they can't force good governance. A country can choose default and isolation over fiscal responsibility if their politics won't allow reform. Turkey in recent years shows another variant. Turkey's president insists that high interest rates cause inflation, the opposite of mainstream economics. He's fired multiple central bank governors for wanting to raise rates to fight inflation. The result: Turkish lira has collapsed. Inflation hit 85%. Turkish bond yields spiked above 20%. Foreign investors fled. The economy suffered. But Turkey hasn't defaulted because it mostly borrows in lira, which it can print. The bond market punished them through currency collapse and capital flight rather than outright default. This demonstrates limits to bond market discipline. A country that borrows in its own currency can always avoid technical default by printing money. But the economic consequences, inflation, currency collapse, capital flight, can be just as devastating. Now let's talk about corporate defaults and what they reveal. In normal times, about 2-3% of junk-rated companies default each year. During recessions, this spikes to 8-13%. During severe crises like 2008, it can hit 15% plus. Each default tells a story about leverage, business models, industry conditions, and management quality. When Lehman Brothers collapsed in September 2008, it wiped out bondholders completely. $600 billion in liabilities. Bondholders recovered pennies on the dollar. The firm that had survived 150 years was gone in a weekend. When General Motors filed for bankruptcy in 2009, bondholders got restructured into equity worth maybe 30-40 cents on the dollar. Better than Lehman, but still massive losses. When Hertz filed bankruptcy in 2020 during COVID, their bonds traded down to 40 cents on the dollar. Then an extraordinary thing happened. Retail traders on Robinhood started buying the stock of a bankrupt company, driving it from $1 to $6. This created enough value that bondholders actually recovered 80-90 cents on the dollar. The unpredictability of recovery values makes credit investing risky. You might carefully analyze a company, determine their bonds are safe, and still lose 70% if they file bankruptcy and recovery is poor. This is why credit spreads exist. They compensate for this loss risk. Over long periods, high-yield bonds have returned 6-7% annually, about 2-3% more than treasuries. That extra return compensates for the 2-3% annual default rate until the 40% average loss when defaults occur. But returns are lumpy. You might earn 8% for 9 years, then lose 30% in a recession year. The average works out, but the path is volatile. This brings us to an important concept. High-yield bonds behave more like stocks than safe bonds during crises. When the stock market crashes 30%, junk bonds often fall 20-25%. They are more correlated with economic conditions than with safe treasuries. This means investors seeking safety should avoid high-yield bonds. They don't provide the defensive characteristics of treasuries or investment-grade corporates. They're equity-like risk in bond form. Leveraged loans are an even riskier variant. These are bank loans to highly leveraged companies, often private equity-owned. They are senior to bonds in the capital structure, so they recover more in bankruptcy. But they are floating rate, so payments rise when rates rise. The leveraged loan market is about $1.5 trillion globally. Much of this debt was issued at low rates to fund LBOs. Now with rates at 8-10% base rate plus spread, many companies struggle to service this debt. The bond market is pricing this risk through widening loan spreads and falling prices. Distressed loans, those trading below 80 cents on the dollar, now represent 10-15% of the market, up from 2-3% in 2021. This signals rising default risk in the leveraged loan market, which could spread to banks that lent this money and funds that bought the loans. Let's talk about where bond markets are headed, because structural changes are reshaping how bonds work and what risks they face. Blockchain and tokenization could revolutionize bond markets. Currently, bonds settle T+1 or T+2 trade date plus 1-2 days. This settlement lag creates risks and requires massive infrastructure of clearinghouses and custodians. Blockchain-based bonds could settle instantly. Smart contracts could automate coupon payments. Tokenization could enable fractional ownership, letting retail investors buy $100 of a bond instead of the current $1,000 minimum. Some corporations and governments are experimenting with digital bonds. The World Bank issued a blockchain bond in 2018. The European Investment Bank issued a Euros 100 million digital bond in 2021. If this scaled, it could democratize bond investing. Currently, bond markets are dominated by institutions, pension funds, insurance companies, sovereign wealth funds. Retail investors mostly access bonds through funds rather than direct ownership. Tokenization could change this, letting individuals buy and trade bonds as easily as stocks. This might improve liquidity and price discovery, but it could also increase volatility if retail traders treat bonds like speculative assets. Climate change presents enormous challenges for bond markets. Physical risks, hurricanes, floods, wildfires can destroy assets backing bonds. Transition risks, stranded fossil fuel assets. Carbon taxes can bankrupt companies and municipalities. Municipal bonds are particularly exposed. Coastal cities face rising seas. Western cities face water shortages. Many municipalities rely on property taxes from assets that climate change will devalue or destroy. Miami Beach has $1 billion in bonds outstanding. If sea level rises 2-3 feet by 2050, large parts of Miami Beach will flood regularly. Property values will collapse. Tax revenue will fall. How will they service their bonds? The bond market hasn't fully priced this risk yet. Miami Beach bonds trade at yields similar to other Florida cities, despite their unique exposure. This suggests either the market doesn't believe climate projections or is ignoring long-term risks in favor of short-term stability. Eventually, climate risk will show up in bond yields. Cities, companies, and countries with high climate exposure will pay higher rates. Those that adapt and transition successfully will pay lower rates. This will create winners and losers on a massive scale. Trillions in bond values could shift as climate risks become undeniable, and the market reprices accordingly. Green bonds financing climate-positive projects are growing rapidly. Currently about $2 trillion outstanding, up from almost nothing a decade ago. These bonds fund solar projects, electric vehicle manufacturing, building retrofits, and other green investments. Demand for green bonds often exceeds supply, allowing issuers to pay slightly lower yields. The greenium, the yield discount for green bonds, is usually 5-10 basis points. Not huge, but meaningful at scale. This creates an incentive for companies and governments to issue green bonds rather than regular bonds. Over time, this could channel hundreds of billions toward climate solutions simply through the pricing mechanism. Demographics present another major challenge. Aging populations in developed countries mean more retirees needing bond income and fewer workers, generating tax revenue to service government debt. Japan is the extreme case. 30% of population over 65, debt to GDP at 260%, yields near zero only because the Bank of Japan buys bonds aggressively. When demographics force them to stop QE, yields could spike and debt service costs explode. The US, Europe, and China all face similar demographic challenges, though less extreme than Japan. As boomers retire, they'll sell stocks and buy bonds, increasing bond demand. But they'll also claim Social Security and Medicare, increasing government deficits and bond supply. Which effect dominates? We don't know. It could go either way. If supply exceeds demand, yields rise. If demand exceeds supply, yields fall. The bond market will find equilibrium, but at what yield level is uncertain. Central bank digital currencies could change everything. If the Fed issues a digital dollar directly to citizens, eliminating commercial banks as intermediaries, it could reshape how monetary policy works. The Fed could pay positive or negative interest directly on CBDC balances. Want to stimulate the economy? Pay 5% on CBDC, encouraging people to hold money. Want to boost spending? Charge -2% on CBDC, forcing people to spend before value erodes. This would make monetary policy more direct and powerful, potentially reducing the role of bond markets in transmitting policy. Or it might increase bond market importance by creating a truly risk-free alternative to bank deposits, forcing banks to pay higher deposit rates, which they'd fund by demanding higher yields on the bonds they buy. The direction is unclear, but CBDC will definitely impact bond markets in significant ways. Geopolitical fragmentation poses risks too. If the world splits into competing blocks, U.S./Europe vs. China/Russia, each bloc might develop its own reserve currency and bond market. This could reduce demand for U.S. Treasuries as China and allies diversify reserves away from dollars. Lower demand means higher yields, higher borrowing costs for the U.S., reduced fiscal flexibility. Alternatively, fragmentation might increase Treasury demand as U.S. allies consolidate their exposure to the dollar bloc and away from China. Impossible to predict, but geopolitics will shape bond markets in coming decades. Here's what strikes me most when I think about bond markets. Your $1,616 monthly mortgage payment represents a promise. You promise to pay the bank, or really, the bondholders who own your mortgage $360,000 plus interest over 30 years. That promise is legally enforceable. If you stop paying, you lose your house. The promise is backed by the most powerful legal system in human history, courts that will seize your property to make bondholders whole. This enforceability is what makes bonds work. Bondholders lend money because they trust the legal system to enforce promises. Without that trust, bonds wouldn't exist. The entire $130 trillion bond market rests on the credibility of promises backed by law. This is profound when you think about it. The global economy runs on debt, and debt is just promises. Promises to pay money in the future, backed by nothing but legal enforcement and social trust. When that trust breaks when borrowers default en masse and courts can't, or won't enforce repayment, the bond market collapses and the economy follows. This happened in the 1930s. Massive defaults on corporate and municipal bonds. Many borrowers simply couldn't pay. Courts were overwhelmed. Bondholders lost fortunes. Trust in credit markets evaporated. The economy spiraled into depression. It took decades to rebuild that trust. New Deal financial regulations, bankruptcy reforms, stronger property rights enforcement. Gradually, bondholders regained confidence that promises would be kept. We take this for granted now. When you buy a Treasury bond, you don't worry whether the U.S. will pay. When you buy a corporate bond, you assess default risk, but you trust that if the company can pay, they will, because the law will force them. This trust is the foundation of the bond market's power. Because bondholders trust they'll be repaid, they're willing to lend trillions at relatively low rates. This enables governments to fund deficits, corporations to invest in growth, individuals to buy homes. Without trust, interest rates would be prohibitively high or borrowing impossible. The modern economy couldn't function. We'd be back to pay-as-you-go financing, where you can only spend what you currently have. The bond market disciplines borrowers to maintain this trust. Borrow too much and yields spike. Threaten default and you're punished with market lockout. The bond market enforces fiscal responsibility not through law or regulation, but through price signals that make irresponsibility expensive. This is power without authority. No bond trader has formal power over governments or corporations. But collectively, through the price mechanism, bond markets force behavior changes that laws and regulations often can't. Politicians can lie to voters about fiscal sustainability. They can promise unlimited spending with no tax increases. They can claim debt doesn't matter. But they can't lie to the bond market. The bond market will call their bluff by demanding higher yields, making debt service unaffordable, forcing fiscal reality regardless of political rhetoric. This is why that bond trader wanted to come back as the bond market. It has power that even presidents and prime ministers must respect. It can end political careers, as Liz Truss discovered. It can force policy changes, as Greece learned. It can enable or destroy economic prosperity, as every finance minister knows. Your $360,000 mortgage connects you to this power structure. You're a tiny participant in a system where promises are made, risks are priced, and discipline is enforced through the cold logic of yields and spreads. When your interest rate is 3.5%, it means the bond market judged you creditworthy and economic conditions stable enough to lend at that rate. When rates spiked to 7.5%, it means conditions changed, the bond market reassessed risk and demanded higher compensation. You didn't negotiate with the bond market. You don't even know who your bondholders are. They are probably pension funds in Norway, insurance companies in Japan, sovereign wealth funds in Abu Dhabi. But their collective judgment of risk and return determines the biggest financial decision of your life. And that judgment reflects their assessment of the entire economic system, inflation expectations, monetary policy, fiscal sustainability, geopolitical risk, everything. This is the bond market's role, aggregating vast amounts of information into a single price that affects everyone. And mostly, it works. Not perfectly. The bond market misses risks sometime. It overreacts to noise. It can stay irrational longer than seems possible. But over time, the bond market's assessment of sustainable interest rates has proven remarkably accurate. Countries that ignored bond market signals, Argentina, Greece, Turkey, paid the price. Countries that respected them, US, Germany, Singapore, maintained their ability to borrow affordably. This brings us to the fundamental paradox of bond markets. They are incredibly powerful but utterly powerless. They can intimidate presidents, but they can't force anyone to do anything. They can signal crises, but they can't prevent them. They can discipline governments, but only through economic pain that falls mostly on ordinary citizens. The bond market is both thermometer and cudgel. It measures economic health through prices and yields, and it punishes poor policy through higher borrowing costs that eventually force change. We live with this system because we haven't found anything better. Planned economies tried to eliminate bond markets and allocate credit through bureaucratic decisions. That failed catastrophically. Democratic control of credit allocation, letting politicians decide who gets loans at what rates, leads to corruption, favoritism, and misallocation. The bond market, for all its flaws, is a relatively honest mechanism. It's not perfectly efficient or always rational, but it aggregates information better than any alternative we've tried, and it disciplines excess better than democratic processes usually can. So we accept bond market power as the price of a functioning modern economy. Your $1,616 monthly payment is your small role in this massive system. You're borrowing from global capital markets at a rate determined by the collective judgment of millions of investors who have never met you and never will. They trust the legal system to enforce your promise. They trust economic conditions to remain stable enough that you'll keep your job and keep paying. They trust that inflation won't erode the real value of what you owe them. And in return, they give you $360,000 to buy a house. This is remarkable when you think about it. Strangers on the other side of the world trusting you enough to lend you hundreds of thousands of dollars, secured only by a legal promise and a house they'll probably never see. The bond market makes this possible by creating liquid, tradable debt instruments, by pricing risk accurately enough that lenders and borrowers can find mutually beneficial terms, by enforcing discipline through yield signals that prevent the system from collapsing under too much debt. It's not perfect. It's not always fair. It creates inequality by benefiting those with assets to pledge as collateral. It punishes countries through economic pain that falls on the poorest citizens. It can amplify crises through forced selling and liquidity spirals. But it works well enough, reliably enough, that the modern economy couldn't function without it. Thank you for taking this journey through the bond market and the invisible power it wields over the global economy. If you found this exploration valuable, please consider liking and subscribing. It helps the channel grow and allows me to keep making deep dive content like this. The next time you make your mortgage payment, remember what you've learned. Those dollars aren't just going to some abstract bank. They are flowing through the largest, most powerful, most consequential market on earth, a market that determines the cost of everything financed with debt. That disciplines governments more effectively than elections. That signals economic turning points before anyone else sees them. The bond market, where promises are kept, risks are priced, and power is wielded through the simple mechanism of supply, demand, and yield. Sleep well, and may you never look at your mortgage statement the same way again.